Hi friends, welcome to RthikBasics. My name is Amit Khadge. In today's video, we are going to cover about different types of taxes. Taxes are another important aspect of personal finances. We'll cover in this video what is a tax, what are the different types of taxes, and get to know about them and how they get applied. So let's start. If you like the video, do like it, subscribe it, and share it. If you have any comments or question, do put it in the comment section. Let's start with the introduction to taxes. Taxes are fact of life for individuals. Taxes are a share or a percentage of your income you pay to the government. It is a means by which government earns income which can then be used by the government for different government programs and services, like to build public infrastructure or like roads, bridges, airports and others, or government schemes like medical benefits and others. In this presentation, we will discuss some of the most common types of individual taxes, including income tax, property tax, and others. On a high level, taxes are categorized into direct and indirect tax. In indirect tax, an individual pays the tax directly to the government. Example of it will be an income tax that you pay on the income that you earn. And in indirect tax, another person or an entity collects the taxes from you and pay it to the government. Example of it will be a GST tax that you have to pay on goods or services that you buy. Here the goods or services are sold by the seller, who in turn collects the taxes from you and pays it to the government. It is important to know about different taxes so that you can accordingly take informed financial decisions, pay taxes and earn peace of mind and help in nation building. Don't avoid paying tax as per laws, but do plan your expenses in order to minimize the taxes you need to pay by keeping in mind the ways in which exemptions or taxes can be reduced in compliance with the rules. In unofficial terms, income earned without paying tax is called black money and will always lead to trouble or unnecessary consequences. Whereas income with all taxes paid is called white money. Stay clear and be compliant with tax rules. With digitization, most of the instances of taxes not paid do get caught by tax authorities, and notices do get sent to the taxpayers on not paying taxes. First tax we will see is the income tax. Income tax is the tax on an individual's earning, a form of a direct tax. Let's say you earn a salary from your job. That salary is your earning. You have to pay taxes on earnings as per the government rules in a country. It is typically calculated as a percentage of the individual's taxable income, which is their total income minus the deductions or exemptions that might be there as per laws. Income tax rates vary from country to country and can also vary based on the different amount of earnings that an individual has as such. In India, income tax applies to individuals based on slab system, where different tax rates are assigned to different income ranges. As the person's income increases, the tax rates also increase. The income tax slabs are revised periodically, typically during each budget. These slab rates vary for different groups of taxpayers. As you can see in this table, there are two tax regimes or two categories of taxes: the old regime and the new regime. The difference between the two regimes is basically in the newer regime, when the government is trying to reduce the number of exemptions and make the tax calculation simpler as compared to earlier. Whereas in the older regime, there are many exemptions and many complicated calculations involved. That's why it's old versus new. The tax rates vary for different slabs in both the regimes, and as you can see, the different slabs are listed over here. In the older regime, you can see that up to 2.5 lakhs, the tax rate is 0. And from 2.5 to up to 5 lakhs, it is up to 5% tax. 5 to 10, it is 20%. And then above 10 lakhs, it is 30%, right? Similarly, on the newer regime, you can see that the tax rates vary depending on the different ranges as such. So that's how, I mean, the tax slabs are in the tax regime that are there in income tax in India. In addition to the income tax, there is another additional component called as the surcharge. In case the income exceeds certain threshold, the surcharge will be applicable. As you can see, there are these different surcharges, like 10% surcharge if your income exceeds 50 lakh, 15% surcharge if your income exceeds 1 crore, and so on. And finally, there is another component called as health and cess at the rate of 4%, which will be added to the income tax liability plus surcharge in all cases, right? So the new tax regime can be largely beneficial for taxpayers who have taxable income up to 15 lakhs, whereas the old regime is useful or beneficial for high income earners above 15 lakhs or so. Let's see an example of tax calculation. We'll keep things simple in this video. For more detailed and complex calculations, you can search on Google different articles about them, but in this video, we are going to keep it simple and small. Before we go to the tax calculation example, let's look a bit about tax exemptions. A tax exemption is the right to have some or all of one's income exempted from the taxation. The majority of taxpayers are eligible for a number of exemptions that can be used to lower their taxes, while some people and organizations are fully free from paying any kind of taxes as such. Some of the exemptions that can come in is from the house rent that you pay, the insurance that you buy, home loan that you might have to buy a house, pension, NPS, or another form of a pension in India, and so on, right? There are many more. These will help in reducing your taxes. We'll see some of these tax details in some of the investment videos that we will see in future. Section 80C is one of the most popular and favorite sections amongst taxpayers in India, as it allows them to reduce taxable income by making tax-saving investments or incurring eligible expenses as such. Max deductions allowed in 80C are up to around 1.5 lakh every year for the taxpayers that can be exempted from any tax as such. Now here is an example of how tax calculation can be done. Here is a person named Rohit, which has a taxable income of 8 lakh. This taxable income is after all the deductions or exemptions that he has claimed for, which, as we talked in earlier slide about the different exemptions that could be there. Now with this 8 lakh as the taxable income, this table shows how the tax is calculated as such, right? So you can see that up to 2.5 lakh, there is no tax. From 2.5 to 5, there is a 5% kind of tax that is getting applied. And from 5 to 10, there is a tax rate of 20%. So that's why 8 minus 5, which is 3 lakh, 20% of that is 60,000 tax that gets for this slab as such. And that's it. So 72,500 is the total tax. And then in addition to that, there is this cess of 4%, which gets applied on top of the income tax, right? So 2,900 is the cess, so that is 4% of 72,500, which comes to the total tax that this person needs to pay is 75,400 rupees as such, right? There is no surcharge involved here because it's not exceeding the thresholds that we had talked about, right? So we are keeping it simple. So here you can see if you have once you have the taxable income defined, you can calculate the tax that you need to pay as per the table that we saw earlier. Now let's look at sales tax, or the GST tax, which is a tax that you pay on the sale, or you have to pay on buying goods or services as such. It's a form of an indirect tax applied on goods like any product, or like soap or furniture, food item, or other things that you need for your consumption or your use as such, right? GST is applied to services as well, like TV subscription, consultation services, and so on. It is typically calculated as a percentage of the purchase price and is added to the final cost of that item or the service that you're buying. GST rates vary from country to country and varies for different category of goods and services. Let's see some examples of how the GST is applied and what are the rates. So here is a table of GST on different goods and services as of year 2023. There are 5 categories based on tax rates ranging from 0 to 28%. Basic needs like milk, eggs, vegetables are not taxed, and that is why it is in 0% category. Whereas luxury items like high-end cars, bikes, durables like AC, fridge are in higher tax bracket as such, which is 28%, right? And even sin items like cigarettes or even online gaming is in 28% category. Then there are these other 3 categories like 5%, where you have cashews, Indian sweets, and others. Then there is 12% category where you have computers, processed foods, almonds, mobiles, and all. And then there is 18% category which has the soap and hair oil, ice creams included in it as such. Now here is a slide on tax implications on your income and your spending as such. Effectively, your net income varies based on what you spend on. Firstly, the income you get is taxed with income tax. Income tax varies based on the earnings slab, as we saw. Post that, with the money you get is called money in hand. What you spend this money in hand then decides how much additional tax you pay. For example, if you earn 100 rupees before tax, with 30% tax slab, you get 100 minus 30 is equal to 70 rupees in your hand. This is your income in hand. With this 70 rupees, now if you buy, let's say, 28% GST category product, you pay then additional tax of 15 rupees as GST tax, which means out of 100 rupees, you pay 45 rupees as tax to government. But if you plan your finances and expenses, you can optimize the tax you pay. Thus, knowing about tax and how it works is super important. Next, we'll see about property tax. Property tax is the tax on real estate like your house, commercial property, and other forms of property. It is typically calculated as a percentage of the property's assessed value and is paid by the owner of the property. Property tax rates again vary by country and also vary by state or province within the country. Normally in India, municipal corporations or Gram Panchayat, where your property falls under, collects the property tax. Property tax is one of the main source of income for municipal corporations. Now let's see capital gain tax. Capital gain tax is a tax on the profit you make on a sale of an asset, such as stocks, mutual funds, or real estate like a house or a commercial property. It is typically calculated as the difference between the sale price and the original purchase price of an asset. So capital gain is the gain, let's say for example, you purchased a stock at 100 rupees and you sold it at 120 rupees, right? So the gain that you made out of this asset is 20 rupees. 120 minus 100 is the 20 rupees as the capital gain. Now the tax is applied on this 20 rupees gain that you have made out of this sale. Capital gain tax rates vary from country to country and depending on the duration for which that asset was held by you as such. Let's see what are the different capital gain taxes for different asset types as such. So here is a table used in India that shows what are the different rates on different assets based on the duration after which the asset was sold. Capital gain is categorized as short-term and long-term based on whether an asset was held for short or long duration. The duration of the gain will be classified as short or long varies based on asset as shown in the table, that for different assets there are different durations as such to be classified as short or long. Like for stocks and equity mutual fund, less than 1 year is considered as short term, whereas greater than 1 year is considered as long term. Short term and long term duration for other assets are also listed in this table. Unlisted shares are shares of companies that are not publicly listed in India, or even foreign company stocks are called as unlisted shares from capital gain taxing perspective. FDs or debt mutual funds are taxed as per the tax slab of the respective, irrespective of the duration that you have held those assets for. Tax rates for equity short-term gains is 15% and 10% for long-term gains. The long-term gains also again apply for equities on above 1 lakh gain as such. I mean, up to 1 lakh of gain is not taxed. Earlier, the long-term gain on equity was almost tax-free, but it was just recently that this 10% long-term capital gain was applied. Overall, you can see that equity or stock investment has low taxes as the risk too is high, whereas the investments, whereas the investments where the risk is low, the tax is high. Indexation benefits helps you further to optimize on taxes for certain assets, as it helps in adjusting your purchase price as per the inflation rate. We'll cover more on indexation in some future videos. Now lastly, let's look at tax returns in brief. What is tax returns? Tax return, or ITR as it is called in India, is a record that calculates an individual's income earned and the amount of taxes that the individual needs to pay to the government. In case there is additional tax that is due with the individual needs to pay that and record it in the tax returns. Or if there was additional tax paid to the government, then the refund has to be sought from the government. Returns are filed after the end of the financial year. In India, a financial year starts on 1st of April and ends on 31st of March the following year. In India, Form 16 is the document issued by the employer to its employee as a record of salary earned by that employee and taxes paid for that employee. Form 16 is then used by the employee to file the tax returns. We have come to the end of this video. There are other taxes too, but the ones we covered in this video are the main ones you should know about. We covered what is tax and what are the different types of tax and how they apply. There are many different types of individual taxes, each with its own unique characteristics and rules. Understanding these different types of taxes can help you make informed decisions about your finances and ensure that you pay the taxes rightly. Remember to consult a financial professional if you have any questions about your taxes. Key takeaway from this video is understand different taxes, pay taxes, and earn peace of mind and help in nation building. Don't avoid paying tax as per laws, but do plan your expenses in order to minimize taxes you need to pay by keeping in mind ways in which exemptions and taxes can be reduced in compliance with the rules. Hope this video was useful. If you liked the video, please like it, subscribe it, and share it. Thank you.